Hi guys, this is KP from InvestorWise. Hope all of you are doing good. So I'm back with another video today, and this has been after a long time that I'm making a video. So I thought, okay, we'll divide this video into two parts. One is general stock recommendation from my end, and the second part of the video will be how should you go about investing in equity now when markets have shown a lot of rally if we compare it with where it was 1 year back when we were hit by this COVID fiasco. So a lot of you have been asking me specifically about two stocks. One is the Britannia, whether you should invest in Britannia or not, and the second one is Bombay Dyeing. I get a lot of queries on these two stocks. I am neither suggesting Britannia today nor Bombay Dyeing, but I'm suggesting something which is very interesting, and I'm very sure not many of you would have paid attention to this particular stock, and I'll give you my reasons why I prefer this particular stock over Britannia or Bombay Dyeing. So the stock which I'm going to take up today is Bombay Burma. The full name is Bombay Burma Trading Corporation Limited. In short, we refer to it as BBTC. A disclaimer right away, I personally have holdings in this company, and I've made lots of my clients invest in this company. This is one of my personal favorite script. At its current valuation, I feel the stock is pretty good. But before we go into the valuations and all, let us just understand the background of the company. The company is one of the oldest companies in India. It is a 150 plus years old company, and is owned by the Wadia Group, which is the leading concern for this company. Now Wadia Group, they started their operations back in 1863, and they started their operations into timber. They were mainly into teak wood, and after that in the year 1913 they have entered into the other segments of business, mainly into plantation, that is into tea and coffee business. Apart from that, they also have presence in the other products like dairy products, biscuits. They are also into healthcare products which relate to dental and orthopedic, and they are also into real estate business. So the company has a wide array of products, and their presence is also not just confined to India. They have a global presence. It is considered to be the second oldest publicly quoted company. So you can understand that the company is old. It is a pre-independence era company, and their reputation, their ethical values, their core businesses, they are very, very promising. Now the question is, what about this Bombay Burma company? So Bombay Burma company in the Wadia Group is the holding company, and it is having stakes in the other businesses owned by Wadia company. One of the businesses owned by Wadia company is the Britannia. Yes, you heard me right. Britannia company is owned by Wadia Group, and they also have Bombay Dyeing. So this company, that is Bombay Burma, they have greater than 50% stake, which means they have a holding interest in Britannia Industries. So you can understand, if Britannia as a stock is doing good, then this holding company is having 50% plus share in this company. So automatically, even for BBTC, it is always going to be good news if Britannia is doing good. And they also own more than 14%, 14% stake in Bombay Dyeing. So rather than investing either in Bombay Dyeing or Britannia, I personally feel we should target the holding company right now because of the pricing of the stock as on date. Okay. Right now the stock is trading at 1160 rupees. We're talking about the price band now. The stock is trading at 1160 rupees. It has done a 52-week low of 535, which obviously happened on 24th of March last year, when we saw a brutal fall in the market when Nifty was heading towards 7,500, and it has done a 52 weeks high of 1565. And now, to your surprise, this 1565 didn't happen in the last 1 or 2 months. It happened on 10th of August 2020, which means one positive signal which you get over here is that now when you feel the markets are at all-time high and probably there are no good stocks to hunt for, this is what I want to prove you, that equity market is it's like an ocean of stocks, And just because we have limited knowledge, we feel there are no good stocks available with Nifty inching towards 15,000. But it's not like that, guys. There are a lot of good companies with very solid fundamentals and still trading cheap compared to its 52-week high. And they still have huge potential left. And that is what exactly is the job of an advisor, to guide you what stocks, even in this bull market, are still trading cheap and you find good value in them. Now, on 10th of August 2020, the stock has done 1565. Right now, the stock is available at 1160, which means even when today the markets are at their pinnacle point, this particular stock is still trading at a discount of close to 26%. Forget about the stock hitting a new high. Stock is available at a discount of 26% as on date. Now, forget about 52 weeks high and low. If I see the price of this stock on 24th of August 2018, it has done a high of 2115, 2115, which means now if you see the value today, almost after 2.5 years, the stock is available close to 50% discount. You can understand, during these 2 years, no bonus has been issued, so you might feel there would have been some corporate action because of which the price of the stock would have come down. No, there has been no stock split since then. There has been no bonus issues done by the company. No drastic changes whatsoever. The stock is trading at close to 50% discount if we compare it with the price that was prevailing around 2.5 years back. Okay, now is it really worth investing in Bombay Burma? If I just come back to where I started from, a company which is having a controlling stake in Britannia and having a good enough stake in a company like Bombay, and at the same time, if you see, the company has been running its business for almost 150 plus years, you can clearly understand that company has to be good to have survived all these years. But still, we don't just want to go by the background of the company. We want to understand if its fundamentals justify buying into this stock. So if I start with the EPS, as I've always told you, as a shareholder, the first and the foremost thing I am interested in is the EPS of the company. And for Bombay Burma, the EPS right now is at 85 rupees. 85 rupees of EPS for any company is mind-blowing. That is the EPS of this company, 85 rupees. But is the price justifying the earnings? The price to EPS, that is P ratio of the company, is close to 20 times, whereas the industry average P ratio is somewhere above 60 times. So companies' P multiples are justifying the value completely. Now, one thing before I continue with my discussion is that I have taken all the figures on consolidated basis, because since it is a holding company and it is holding major stakes in Britannia and Bombay and some other companies, so I don't want to go with the standalone figures. Standalone figures of Bombay Burma may not give you a very good picture. But for companies like Bombay Burma, which are the holding companies, the valuation methods have to be used based on their consolidated figures, because as I told you, if there is any good news for Britannia or for Bombay, then it is going to have indirect impact even on BBTC, right? If I talk about its book value, it is having a book value of greater than 1,000 rupees. To be precise, it is 1047.12. That's the book value for the stock, and its price to book value is as low as 1.11. That is pretty low, guys. If you see now that the stocks are trading, almost all the stocks are trading at a 52-week high, right? And if you see the price to book value, this is one of the favorite multiples which I use in my valuation methods. Most of the companies right now are trading at a premium price to book value of 5 or 6 times. You should see stocks like Bajaj Finance, Bajaj Finserv, or you should see the pharma stocks, or you should see the IT sector stocks. Most of them have their price to book value greater than 5 times, barring some of the public sector companies which are still having a low price to book value. And that is why you see these companies are now showing a lot of jump in the last couple of months. If you would have seen, a lot of private sector companies, the public sector companies have shown decent upside in the last couple of months. So companies price to book value close to 1 is a very, very positive signal for us that yes, the stock is a quality stock and it is underpriced. If I do the profit analysis of the company going by their PL numbers available from March 16 to March 20 end, which is a total of 4 years, the net profits have jumped from 791 crores to 1147 crores. 791 crores have become 1147 crores in a period of 4 years, which has shown a staggering jump of 45% in net profits. The sales figures have gone up from 8,761 crores to 11,890 crores. And again, we see a huge jump of 36% over a period of 4 years. If I only consider 2021, then from September 20 to December 20, if I compare it to last quarter, the December 20 results, which are latest available results, if I compare it with September 20 results, their net profits have gone up from 360 crores to 367 crores. So we still see there is an improvement. But if we do a year-on-year comparison of profits from December 19 to December 20, if we compare, there has been a 48% jump in net profits on a consolidated basis. From 248 crores, their profits have gone up to 367 crores. That is a huge hike in profits, even during this kind of an economic scenario where things are not going really good or ideal for the companies. If I look into their balance sheet, they have a very, very small equity of just 13 crores. That's it. That is why the beta of this company is close to 1.1, making it a little more aggressive compared to the other stocks which I have done analysis on. You would have seen the beta values ranging in the somewhere between 0.5, 0.6, 0.7 times. But this company has a beta value of 1.1, which means the stock does show you good momentum. The one reason for that is the lack of liquidity in the stock, and because of the fact that the equity is very small, so some good buying comes into the stock and the stock just zooms up by 125 rupees. And they are sitting on a very good reserves of close to 5,000 crores. With an equity base of just 13 crores, if the company has 5,000 crores of reserves, that is a pretty good number. As far as the debt is concerned, they have a very small debt percentage, which is just 0.37% is the total debt which they are having. They have a good interest coverage ratio of 15 times. So I have told you earlier also, interest coverage ratio helps you understand how good are the earnings before interest and taxes to take care of the interest burden. The EBIT divided by interest expense is the formula for interest coverage ratio. A ratio close to 1 is considered bad, but in this case we have an interest coverage ratio of around 15 times, which makes it pretty comfortable as an investor that yes, company is having enough earnings to pay off its debt. Their return on capital employed is close to 23%. That is again a very, very solid and healthy number. Return on equity is obviously slightly lower, which is close to 11.75%. That's because of the debt and the preference shares. Their return on equity is close to 11.75%. If I go by the shareholding pattern, the promoters are holding close to 66% in the company. That is another very positive signal I get from this particular company, is that the promoters are not leaving on their stake, and that gives you a clear-cut picture that the promoters, they are having a lot of faith in the company and they don't want to dilute their ownership in the company. Moreover, this entire holding of close to 66% is unpledged. It's completely free holding for them. FII has been slowly and steadily increasing their stake in the company, which now stands close to 7% of holding by the FII. DII is having close to 12.38% stake in this company. Now, if I look at all these aspects and I consider the discounted value for the stock available at this point of time, I personally am very, very bullish on this stock. The thing is, guys, once we reach the levels in the market where index is hitting a new high every day, we have to be very careful in picking up the stocks. And in such scenario, I feel Bombay Burma is one very safe investment with a very limited downside and a huge potential for upside. Since the stock, even if we just compare, forget about what the valuation was 2.5 years back, you would not believe me, there are reports available on social media or on Google where the valuation justified for this company, because of the fact that it is holding very high stakes in Britannia or Bombay, and the company overall is very, very wealthy. The intrinsic value for the company, as per some analysts, has been justified at 5,000 rupees. You can understand the stock is almost like, if I go by these valuations, the stock is almost trading at 1/5 of its value. I'm not talking about a very long-term perspective over here, because the idea of making videos most of the times is that you should get a justified upside in a couple of months' time. So for me, at 1160, if you buy this stock, I feel the first target, which seems to be very, very easygoing is 1265. That's my first target. Anywhere between 1250 to 1265 is the first target, which I feel we can achieve in a very small span of time. And my next target for the stock would be close to 1350. But 1350 is where I feel the stock has seen a lot of resistance. On multiple occasions I've seen stock drifting down from the levels of 1350, but this time I feel if it is able to survive above 1350 levels, then it is also possible to see the stock going back to its 52-week high price, which is anywhere above 1500. So if you're a short-term investor, my first suggestion would be to hold this stock for around 1265 rupees. Anywhere above 1250 you can book your profits. The second target would be close to 1350. If it is able to cross 1350 mark and sustain those levels for a couple of days, then it might even go past its 52-week high price. I don't want to keep any stop loss for the stock. If you're a trader, I suggest that you see your risk appetite and decide on the stop loss. I would not go for a stop loss in a stock like Bombay Burma, which is fundamentally a stupendous stock. But yes, if the price further comes down from this level because of the volatility that we are experiencing in the market, if the stock further dips down by 125 rupees, maybe then you can use that fall in the stock price for some averaging. So my suggestion is, no matter how promising you feel the stock is after watching this video, I don't want you to buy your entire exposure in this company at one go. So if you plan to buy 200 shares, my suggestion would be to probably go with 150 shares and keep a cushion of averaging out at lower levels, maybe by adding another 50, 60, 70 shares as you wish to do. But don't take the entire exposure at one go, given the volatility that we have in the market. I hope you enjoyed this stock recommendation from my end, and we hope, like always, we would be able to post a video very soon about the stock hitting targets. Apart from that, guys, the second part of this video which I wanted to discuss is, with so many new clients coming in touch with me and asking me, is this good time to start investing in the market? First of all, I feel you need to understand, when you waste a lot of time thinking what is the right time to enter the market, I give you one simple answer to that. The answer is, it's always a good time to start investing in the market. You need to understand, are you anticipating something as wild, as sudden, or as surprising as we witnessed the COVID-19 situation last year? Do you expect anything like that to happen again? Yes, there may be one more wave of coronavirus. We might have some difficulties with the vaccine's accuracy, but do you expect something like that again to happen in a short span of time? The answer is clear-cut no. If the answer is a no, then you don't even expect some great corrections happening in the market. We might have small corrections. Small corrections are always considered healthy because they create opportunities for you to re-enter the markets and re-enter the stocks which are fundamentally good. Like for example, you see on Thursday the BPCL was trading at 467, 468 rupees. Yesterday, on Friday, it came down to 440 levels. For somebody who would have sold his BPCL at 468 rupees, you get it back at 20, 25 rupees down. You know BPCL is entering into privatization. The valuations of the company have been done close to 550, 575 rupees. For you, it's a good opportunity to re-enter the stock 25, 30 rupees down. Maybe you can again buy back the stocks. You have to look at corrections as an opportunity to re-enter the market and buy the stocks which you feel are justified for their value. You can't have a robust kind of an action where you are either sitting on the fence or you are investing in the market. No, I personally don't believe in that, because I am not a speculator. So I tell you not to speculate in stocks. And the irony is, there are people who are speculating on the market as a whole. Is this the right time to enter the market? Should I stay away from the market for some time? Why do you want to stay away from the market? You be a part of the market, but make sure that you buy things which are worth for your money. That is what you need to do. So even if I look at the situation like COVID-19, you see we hardly took any time to recover from a situation like that. Now, things like COVID-19, it does not even happen once in a century right? So for something which happened once in a century kind of a thing, still markets were capable of recovering from that kind of a scenario in less than 6 months. So what happens even if you keep invested in the market and some drastic or really thing happens which gives a good hit to the market? Still, what will happen? You just have to sit on your investments for 3, 4, 5 months, and then you again see the recovery in the market. Now, anticipating something which is once in a century kind of a scenario, you can't stay away from markets. Come on, you have to understand there is opportunity cost of your money, and you just have to make sure that you look for opportunities where you find stocks are decently placed as far as their fundamentals are concerned, and they should not be overvalued for their fundamentals. That's all you need to check for the stocks before you invest in them. And don't just get carried away with the motion. If markets are going up, probably everything is going up and you are enjoying this bull run. That is where people tend to get trapped by buying shitty stocks which are not justified for their value, but you still buy them, and you might be lucky in the market for a while, because when everything is going up, you will only see green color in the market, and you will only see your portfolio generating profits for you. But that's not how we do investments in the market. At any given point of time, your total exposure in the market, no matter whatever it is, you have to make sure that everything that you buy should be justified for its value. And if from there, even if there is a correction, like to be very honest, I have purchased Bombay Burma close to 1250 rupees, and a lot of my clients have been made to buy Bombay Burma close to 1250 rupees. So even today, when the stock is trading at 1160 rupees, I have no fears, and I tell the same thing to my clients also, that we need not worry. The stock is going to go up either today or tomorrow or maybe after a month. Does not matter. We will hold on to it. At the end of the day, if you know to buy right stocks in the market, you have the patience of holding on to them, you have the confidence that you have purchased right stocks. At the end of the year, if you compute your returns, your returns in equity markets are 100% going to be far more superior when compared to any other asset class globally. Any other asset class, no asset class can match up to the returns which equity markets are capable of generating, provided there is only one condition: you have the knack of picking up stocks which are fundamentally good, they are underpriced or they're fairly priced, and you have the patience to hold on to those stocks. If you are a speculator who is only trading in the market, having some upside targets or downside targets and putting stop losses, then that's a different ballgame. I have nothing against you, but that's not my way of doing markets. In my dictionary, there's nothing called stop losses. So I do my research properly before buying something. Yes, if there is a drastic change in the corporate governance of the company or the management issues have risen up, then we might have to exit the stock. But that, with listed companies, with SEBI being the regulator, you going through the stat audits, internal auditors being vigilant about the company, it's 1 out of 1,000 companies where you might face a situation like what happened with Vakranji or with PC Jewelers or with DHFL. But chances are very less that you will come across counters like these. The probabilities are very low. So that's it, guys, from my side. Keep investing in the market. Stop worrying about what we are expecting next from the market. Small corrections will come here and there. What happened on Friday has nothing to do with COVID-19. It was just that we are anticipating bond yields will go up. Why bond yields will go up? Because we are expecting inflation rates to go up. If inflation rate will go up, even for equity, the discounting value will go up. Now, equity value is just a discounting of future cash flows. We use the discounted cash flow techniques. This is a little technical, that's why I'm speaking all this at the end. So when you have a higher discounting rate because of higher inflation, the justified values will go down. If justified values will go down, then equity shareholders will not be willing to pay the price for the shares at what they are prevailing at this point of time. Because of that, some correction has happened. Was that correction justified? Again, I feel that was an overreaction from the market, what exactly happened on Friday. And since the markets are at all-time high, we just need reasons to book profits. That's it. People, out of fear, they will book profits. But for me, again, I look at it as an opportunity. Some of the stocks which I always felt, they have went very high, Friday gave me an opportunity to re-enter those stocks. So yes, that is the reason why you need to hold on to some of your capital as idle funds and use these opportunities where you see drastic fall in the market with Sensex crashing close to 2,000 points. That is where you have to put in your fresh capital and take advantage of such scenarios. There's a lot to learn, guys. Even I'm learning. Even with a decade of experience, I'm still learning so many things in the market. For all of us, there's a lot of learning in the market. It teaches us every day something new. So keep enjoying your investments. Equity as an asset class is very, very important. Once you build up on your portfolio, you will understand equity is capable of creating a second source of income for you. Whether you are into a practice, whether you are into consultancy, whether you are into a corporate job, you have to create equity as an asset class, which creates a second source of income for you. I personally believe in doing direct investments in equity, because then things are directly under your control and you can exactly monitor what's happening with your portfolio. Whereas in case of mutual funds, if you see, you do SIPs, but SIPs only for accumulating your capital or wealth is okay. But for doing sheer investments, I feel direct investment in equity is the way to go. I hope you enjoyed the video, guys. Till we meet again, cheers. Bye bye. God bless all of you. Thank you, guys. Thank you.